It is Fed week, so in today's video, we're going to be looking at US indices, specifically the NASDAQ 100, and it's dropped to a 5-month low. The following information is not to be considered investment advice or investment research. Capital.com will not be liable for any losses from the use of the information provided. Hello, welcome back to our channel. My name is Daniela, and as I said, today we are going to be looking at US equity markets, specifically previewing the US central bank meeting that will happen on Wednesday this week. So we know the Federal Reserve will be meeting and deciding how to adjust its monetary policy to current conditions if it needs to. But before we get into this video, please like, comment, subscribe, and turn on your notifications. So with regards to the Federal Reserve meeting, it is a very important meeting on the calendar, not just for US markets, but in general for the wider market as well. It tends to have a greater impact. But this meeting actually, probabilities in the market pretty set on the fact that we won't see the Federal Reserve hike interest rates. We know they paused at their previous meeting, but messaging at that meeting and since then has been suggesting that we could see further rate hikes if the data so deemed so. Now, we have had some data since that meeting, and the data has shown, once again, a pretty strong image of the US economy. We actually saw the US GDP coming in higher than expected just a few days ago. And of course, that was slightly shifting expectations. The GDP data for the third quarter coming in at 4.9%. Markets were expecting it to rise to 4.3 after coming in at 2.1 in the previous quarter. CPI for September also showing some resilience, 3.7% unchanged. Markets were expecting it to drop to 3.6%. Retail sales also coming in higher than expected. The NFP data as well, the unemployment rate holding steady at 3.8%. All of this data has come since the previous meeting in September. So we do have, once again, this image of a strong US economy. And how does that fit in with the Fed's expectations? Well, we saw an appearance from the Fed chairman, Jerome Powell, a few weeks ago now. And at that meeting, he was essentially saying that if the rate is held at the current level for the foreseeable future for long enough, then it will have a greater impact towards the long-term inflation goal. Similar to what we saw from Christine Lagarde at her meeting on Thursday last week. We did see the ECB as well pause their hiking cycle. But the feeling we get from Lagarde and the ECB is that the previous rate hikes have had a significant impact on growth already. In fact, if we look at the latest data, GDP for Germany dropping on the quarter. We've seen now a technical recession in Germany. CPI as well dropping. We've seen retail sales and sentiment in the greater Eurozone area also having dropped. We'll have GDP and CPI for the Eurozone as a whole tomorrow on Tuesday, which will give further insight into that. But the feeling is that the impact of previous rate hikes on the Eurozone economy has had a greater impact so far. As we're seeing because of the latest data for the US, it doesn't seem to be the case just yet. We are still seeing very resilient economy in the US. It continues to grow quarter on quarter. And of course, that will change the messaging a little bit from the central bank. In fact, if we compare Jerome and Lagarde's messaging, we have seen Jerome, as I said, indicate that the current rate seems to be substantial enough, but we haven't yet seen those comments from him that previous rate hikes have had an effect on the economy, because we're just not seeing that in the data just yet. But in terms of market expectations, 100% chance that we will see no hike from the Federal Reserve. I mean, you can't get any more assurance than that in terms of market pricing. So that is essentially what we're expecting. No change in monetary policy. I expect Powell to remain in his hawkish stance, saying that whilst they see no reason right now to keep on hiking. If the data continues to show this strength, then it's likely that we see another rate hike down the line. Market expectations are dropping for the fact that we may see another hike towards the end of this year. And the first cut continues to be priced in for the summer of 2024. So not much expected to change at this meeting. Of course, markets will still be very much focused on the messaging from Powell. It could be a non-eventer, this meeting, especially in terms of volatility for market, if it does come exactly as expected. Markets are pretty sure on what's going to happen with the decision. They're also pretty sure as to what Powell's decision and posture is going to be with regards to rate hikes in the economy. So it could be, as I said, a non-eventer there. But of course, we've got to look at the stock market and how it's been performing. There has been a lot going on. And whilst the Federal Reserve is the focus for this week, we have seen, of course, over the weekend, intensifying conflicts and attacks in the Middle East. As we know, Israel now intensifying the attacks on Gaza. And of course, that has seen a little bit of risk appetite priced out of markets. We continue to see gold pushing higher. Gold is definitely the preferred safe haven right now in markets. Of course, the US dollar does come from a period of being quite overextended. So investors slightly cautious with regards to piling into the US dollar. They have been doing so for gold right now. In terms of the stock market, of course, this puts a little bit of a negative bias in the short term. A lot of this uncertainty usually making investors reassess their positions in those more volatile assets like can be stocks. And we've also had the earnings season in the US, and it's been a little bit of a mixed season. We've definitely seen poorly received earnings. And as we know, the NASDAQ 100 is heavily geared towards the technology sector. The Magnificent Seven have been driving the majority of the rally in 2023, are the largest component of the NASDAQ. And we've seen these earnings from them coming out. And really, the reaction in the market has been quite negative, even though earnings have held up pretty well. I mean, they haven't been outstanding, but they've definitely held up to expectations. But I think the fact that they failed to deliver anything outstanding has kind of given that markets a little bit of a dissatisfied sentiment. Definitely what we're seeing in the reaction after those earnings. And again, coming from a period where the rally has been quite overextended, it feels like it's just the end of a cycle potentially. In terms of, we're looking at individual stocks. For example, we've seen Alphabet delivered good earnings, but we saw a big pullback in their stock after they had a smaller than expected profit in their cloud computing sector. So of course, after that AI hype that drove a lot of the momentum in the summer, we are starting to see, those cloud computing sectors really focused on from investors. So Alphabet's miss there really weighing on shares. In fact, it also caused Amazon stock to drop prior to their announcement because investors were anticipating potentially similar problems for Amazon Web Services, the big cloud computing sector of Amazon. So in general, we have seen earnings holding pretty well. For example, Meta, we've seen softer advertising spending, and that, of course, has caused their stock as well to pull back. So stocks have been punished after this earnings season. Of course, they said that risk-off sentiment from the Middle East also weighing, and expectations the Federal Reserve will continue to keep rates elevated, of course, weighing on that. As we know, with these higher expectations, we do have higher long-term rates on bonds. Of course, those are the ones that are used to discount future cash flows for these companies. So these higher rates do actually mean lower valuations for companies, especially those that are expected to deliver high growth in the future. These higher rates will continue to weigh on their valuations and therefore their stock market price. So that is pretty much it. As I said, Fed in focus this week. Of course, keep an eye out of what's going on in the Middle East and how the earnings season evolves. Let's take a look at the NASDAQ's chart now. As always, Capital.com via TradingView. As you can see here, the NASDAQ really pulling back. It's down to, as I said, 5-month lows, shed about 11% since the highs back here in July. This was the hype of the AI push, and we also had a lot of the data showing a really resilient economy in the US, which was driving a lot of this bullish momentum in the stock market. Since then, we've seen that pullback take strength. We've seen a few recoveries along the way. Those buyers not quite sure or prepared yet to let go of the potential of higher returns. Now, of course, with the risk-off sentiment intensifying throughout the month of October, with the tensions in the Middle East, we have seen the NASDAQ now pulling back, as I said, to a 5-month low, attempting to recover today, this morning, also on Friday, attempting to undo some of the losses that we saw on Thursday and also on Wednesday when that intensified. Of course, one day of attempted reversal is not going to undo the greater sentiment out there, which is a little bit of a negative bias in the short term. We've also got the 200-day simple moving average here, this yellow line. Don't know if you can see, but it's currently hovering just above that 14,000 mark. So again, It could be a nice psychological level to watch out for in the coming days. The RSI holding up actually pretty nicely after the attempted rebound on Friday. As you can see, just managed to skim the oversold area there. So we are now back trending higher on the daily chart. But again, the negative bias with everything that's going on and the focus on the Federal Reserve could see buyers struggle to really recover that momentum. Let's take a look at the weekly chart to see what the picture is showing here. Again, similar setup. We've got the RSI now dipping below the midline, the 50 line. So again, showing a little bit of a negative bias, but not quite there yet on seeing this as a full-on bearish pullback. Of course, having dropped more than 10% below those highs in July, we are in fact looking at a bearish market. Definitely the cycle now. It's just a question of are these bears now satisfied that they have pulled back from that level, or is there further room to continue and to come back and potentially retest some other levels that we've seen in the past? So for now, as I said, I would be cautious trying to buy into US equities. In terms of the Federal Reserve meeting on Wednesday, it's unlikely that we see them offer any dovish remarks. As I said, with the data that's come in lately, even if we do see a rate pause, which is the most probable scenario right now, it doesn't necessarily mean that that is the Fed giving in to the fact that there will be no more rate hikes or that the economy is going downhill from here. And that's why I think messaging from Powell is going to be very important. But if what we've seen in the last few weeks happens again, he will very much put emphasis on the fact that inflation still continues to be a concern. The fact that the economy continues to grow will only put further upward pressure on inflation, and therefore the rates need to be kept higher for longer. That kind of messaging can continue to weigh on stocks further. So we could see once again the NASDAQ 100 pulling back on the meeting. That is it for today's analysis on the NASDAQ 100. Thank you so much for watching, and don't forget to subscribe to our channel.